Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And today we're going to put a little bit of focus on stock charts. We're going to be using technical indicators to time the entry of when to buy a stock and maybe when to sell a covered call against that stock position. I think this is going to be an interesting discussion. I'll lay out a more precise agenda for how we're going to accomplish that in just a moment. But let me first of all say hello to everybody who's chatting in out there in YouTube. Hello, all you familiar YouTubers. Great to see so many good names out there. Will and Eva, Greg, Posh, Lawrence, Jay Richardson, Tony, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're checking in on the YouTube archive after the live stream has concluded, enjoy that recording, but be aware that you're invited to join us during the live stream. If you'd like to be here, this is a Monday webcast series. We kick things off promptly at 2 Eastern Standard Time, or Eastern Time. I also want to let our live stream audience members know that we have a very special guest here today. We have Ben Watson. He's going to be hanging out in the chats. He's going to be addressing any questions that I can't get to just during the flow of the presentation. Ben and I have now been working together for more than 2 decades, so he brings a ton of experience to this discussion. Thanks for having my back there, Ben. And Ben and I would also like to issue an invitation to everybody listening. If you have an account on X, you should be following your favorite presenters on X. It's the best place to connect with us in between the live streams. You can find Ben there at Ben Watson CS. You can find me on X at Cameron May CS. All right. But let's get into this discussion. And as we do, of course, we need to first of all consider the risks associated with trading and investing. This is important information, so please bear it in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. So, with all that important stuff accomplished, let's set the agenda for today. This video is part of an ongoing webcast series. So the first thing that we're going to do is look at our existing positions, see how they're coming along, see if there's anything that we might need to do with those regarding the management of those current example positions. A little bit of a spoiler alert. I don't think that we're going to be doing anything with existing positions today, just a little bit of a health checkup. Then we're going to take a look at the markets, see what's going on with the stock market and the options market as a backdrop for today's discussion. And that discussion is going to be when trading covered calls for income, what might a trader look for on a stock chart as a signal that, ooh, it's time to buy that stock, or, oh, it's time to sell that call for income. They can actually be very different signals. So we're going to be looking at both of those. We're going to be putting those into practice by planning and placing an example trade on the Thinkorswim desktop's trading software platform. So a lot to cover. Let's get right to it. Let's go to the Thinkorswim platform. So here we are in a simulated trading environment. We have 5 example positions right now. Let's start here with Bank of America. We own 200 shares. We've sold 2 calls against those shares. Those were the 10th of October contracts at the $51 strike. So the preference here for the trader may be, if they want to retain ownership of the shares, the stock go up, but not go above that 51 strike. Well, actually, we've gone above that $51 level. This really does put a highlight on the fact that when trading covered calls, these contracts can go in the money and the risk of assignment can go up as a result. Let's go see what's going on with our BAC position. So here's the trade as it's gone so far. Bought shares here. Now we bought those shares, the 200 shares, at $50.58. Then we sold a contract, obligating ourselves conceptually. We might have to sell those shares for $51. So, yep, if we do get called out, we'd be selling those shares for a small profit that would be added to the premium already collected, if assigned. But yeah, the trader may prefer that we stay below $51. We've actually gone up above $51 and now trading at $52.20. So someone else may choose at any time to buy those shares from us at 51. That would realize the gain on the stock. It would also realize the gain on the contract, and that would be a profitable exit. But it might sting a little bit for a trader who would prefer to hold on to those shares at $52.20. So I thought today maybe we'll focus on how might the trader minimize that as a likelihood in the future, at least conceptually. Try to minimize. All right, but I'm going to come back to that sort of a scenario after we've looked at other positions. So what can we do about things right now? Well, if we wanted to, the trader might choose to go buy their contract back. The $51 call, guess what? Being this far in the money, it's going to cost more than $1.07 to exit. So we very likely be realizing somewhat of a loss, a small loss most likely on those calls, in order to free ourselves from the obligation to have to sell the shares at 51 bucks. That would allow retention of the shares at 52.20 if we're able to get that exit order filled. I'm not going to do that today, though. All right. So we're going to let that one continue to work. There is no risk of early assignment in paper money. That's not real. That's not the way real life works, though. Early assignment is a reality in real life. It's always a possibility. We can throw in the word risk. Yes, there's a risk that we might be forced to close out a profitable trade. Right. But yeah, that's a possibility. CSS might could we roll it? That's another possibility. Close out of this one, most likely to loss because we sold this contract for 107. Looks like it's trading for 162. So it looks like that might be about a 55-cent per share loss on that contract. Maybe sell a contract further out in time, maybe at a higher strike. So we're not obligated to sell at 51. Maybe see if we go to 52 or 53. But that new contract may also itself ultimately go in the money. So there are pros and cons to this. Plus, if the stock reverses course after we've already incurred a loss on the current call position, even the stock might lose money. So there are pros and cons that the trader might want to weigh there. Let's move on to our NEE position, though. Similar position, 200 shares, sold 2 contracts. These are at the $75 strike. And you can see this has actually crept up a little bit above 75 at the moment. So if we go look at NEE, it has a little bit more of a history. So this position, we actually owned the shares as a result of selling a put back here, 17th of April, $72.50 put. We collected a 156 premium. We were assigned at $72.50. And then we started selling calls against those assigned shares. This call we closed for a profit to add to the profit that was already realized on this short put. This call we sold for a profit, closed that for 97 cents. And right here, we've sold the 17th of October, $75 calls for an additional $1. Our break even is down at 68.41. So you can see we're solidly above break even, but we are in position where, again, this has gone in the money. If the contracts are assigned, we wind up selling the shares at 75 bucks. We purchased those at 72.5. That would be a $2.50 realized gain if that happened on the shares to be added to the premiums that we've collected along the way. So this trade doing fine. We could consider closing out. We might consider rolling. I'm just going to let this one continue to work. It still has 18 days till expiration. Assignment risk conceptually is there in a real trade, but 18 days out from expiration, the risk is probably lower than if we were deeper in the money or closer to expiration. Let's look at NVIDIA. NVIDIA is our trade from, was this last week's trade? Let me click on this. I just have to remind myself. It was. Yep. So this is a short put. We sold at the 175 strike. Now, this one was with the premise that maybe the trader was making an effort to possibly buy the shares at a lower price. So if assigned, that would be buying at a price lower than on day one. This is not looking like assignment is very likely at this point. Things could change. There's still 18 days. But with the 175 put, stock's up at 182, going up. This is actually this is a bullish position. This is fine for the trader, as long as they're okay with just, if this gets to expiration unassigned, well, the original premium collected, $3.85, represents the amount that the trader could make. Let's go look at this, though. This one we have, this one also has a little bit of a history here. We originally sold a 15th of August 170 put, and that one just expired. Made a $2.58 profit. So we've sold another premium, $3.85 at 175. And you can see the stock is going up. That's making this less likely to be assigned. So if that expires, we just have a combined realized profit of about 333, something like that. Anyway, that's very rough math. I know I'm wrong. Anyway, it's over, not three, sorry, $6 and change. In any case, between those two premiums, the net break even for looking at both of those trades is down here at 168.57. And we do have a stop in place to take the position out if the price of the stock falls down into that area. We have a stop in at 168 to buy that put back. Now, up above, we also have a limit order in place. This is actually based on the price of the option. If this $3.85 option can be purchased back for 75 cents or less, this would take us out of that trade. R1 says, how are the original options assigned at 72.50 if there is no assignment? So R1, now let me clarify, there's no early assignment in paper money. There is assignment at expiration of all in the money contracts on paper money. That's the way paper money works, okay? So that's what happened there. We allowed it to go to expiration and it was assigned. So going on to, so our NVIDIA trade, doing fine. We originally received a credit of $3.85. It's now about $2.85. We're up about $1 on that trade right now. We'll let that continue to work. With Visa, covered call, 355 strike. We'd like to be probably below the 355 level on the 17th of October. And we're at 339. So here's what that looks on the chart and where it fits into the storyline for this trade. This is another put that was assigned, again, at expiration. That was after selling an original put that just expired. So we wound up with share ownership here. We were already in the money with a couple of realized gains. Sold some calls here, realized a gain here, sold a call here. This one's working its way toward expiration, but quite a ways out of the money. We're well above our break even net of all these premiums. We have a plan. If this support breaks, we're probably going to pull the plug on this trade, but it's been holding in there. Eva said, oh yeah, earlier today there was a random survey on Scott Thompson's class. He chatted that it was funny since he reads all surveys, found that humorous. Yeah, he does. Yeah, we read our surveys. Definitely always appreciate when you fill those out. Okay, one final position. We're going to let that one continue to work. It hasn't broken support. It hasn't gone through the strike. With Walmart, we have a covered call at 105. So a preference here might be for the stock to stay below 105, and it's at 102.15. Here's the history with Walmart. Got to put here assigned at $95. So if we're in a contract right now, if we're called at 105, that would be a $10 gain on the stock. Along the way, we had another call that realized a profit. So our net break even is actually down here, $91.12. And we did actually tease against this 105 call about 2 weeks ago. So this did go in the money, but it's a good reminder that just because a contract goes in the money doesn't mean that it instantly gets assigned. Actually, a contract can be assigned at any time, whether it's in the money or out of the money. It's just as we go in the money, going deeper in the money can raise the risk of early assignment. Getting closer to expiration can raise the risk of early assignment in a real live account. Paper money, we don't have to worry about early assignment, but we don't want to let that create a false sense of security when we transition, if we transition to real trading. All right, but this one, again, still out of the money, still some time to go, well above our break even. Let's let that one continue to work. So that's it for our current positions. Let's go plan and place a new covered call. But as we do, I do want to take a quick look at the sort of environmental backdrop for trading covered calls right now. Now, these are bullish strategies. So are the markets bullish? Well, they seem to be. From a technical perspective on a stock chart, looking at the S&P 500 index, we can see that the bullish run that started back here that very first week of April just continues. We had a bit of a pullback over the last week, but this is starting to shape up like a possible bounce. Will that continue through the end of the week? Possibly. Could it carry us through this next third Friday expiration? I think possibly as well. But let's keep that in mind. Let's say that we are a covered call trader looking for income, and at least we want to see for the time frame of the next trade that we're planning that things look more bullish than bearish. Because I'm going to be adding to stock positions here. And so for a trader, maybe they just want to make sure that for the adding of new bullish positions that the markets appear to be bullish. Now, obviously, time will tell. R1 says, is there a way to simulate the assignment in paper money? No, not really, R1. We can just be aware of how assignment, the thing is, it'd have to be a fully randomized simulation. Paper money, well, in real life, we never know when or if assignment is going to happen. We can assess certain variables that may raise the risk of early assignment, but even under those circumstances, assignment is less likely than not in most cases. We just don't know exactly when it's going to happen, but going deeper in the money can raise the risk of early assignment. Getting closer to expiration, especially while in the money, can raise the risk of early assignment. Also, if a dividend exceeds the extrinsic value of a contract, that can start to raise the risk of early assignment as well. But then again, somebody might just get a wild hair and say, you know what, I want those shares for whatever their reason might be. All right, so that sets the sort of technical stage from a charting perspective for our would-be covered call investor. And let's just say that their outlook is for at least prices likely to rise from now until that 17th of October expiration. So now they're going to go to their stock and plan and place a new trade. But I wanted to look at this through the lens of using a technical indicator to maybe assist the trader in timing the entry of the stock position, but also the timing of the entry on the sale of the contract. So for today's example trade, we're going to be using Amazon. Let me just bring up a chart of Amazon. And you might wonder why Amazon. I like to set that as a backdrop. Number one, a trader might emphasize price per share can be a big consideration with trading covered calls. Obviously, higher priced stocks carry a higher cost of entry for selling covered calls for income. Now, a second consideration is the liquidity for options traders of all stripes. An illiquid stock tends to have illiquid options, and we can have very wide spreads between bid and ask prices, and that can lead to liquidity issues trying to get into and out of those trades, make them harder to trade profitably. So, price per share is a consideration for a lot of options traders. The liquidity, but also what's happening on the chart. Now, I don't want to say that those three things are an exhaustive list of what might go into selecting a stock. There might also be sector considerations or fundamental considerations. But let's look at what's going on with our stock chart. And I want to talk about the scenarios under which, at least conceptually, a trader might choose to buy the stock, and also the scenarios under which the trader might choose to sell the call option. So focusing first on stock, well, stock ownership is bullish. So within the normal movements of a stock, we might see prices rise and fall and rise and fall. We've all heard the phrase buy low and sell high. Well, how might that be quantified on a chart? Well, one potential thing that a trader might look for is for prices to fall down to a support level. Now, in this case, what you'll notice on Amazon is it seems like there's almost an invisible ramp holding up prices. Prices rise and then they fall. They rise and then they fall. But as they've fallen, as they hit those cyclical lows, it looks like we're finding what we call price support around this rising trend line. So one initial cue for a trader who's looking to hopefully optimize the entry of their stock is for price to be apparently bouncing off of one of these price floors or a price support. Now, a confirmation of that bounce that you'll sometimes hear our coaches talk about, you'll hear it talked about elsewhere, is for the trader to look for price to fall down toward the apparent support. And whichever candle reaches down the furthest, they just refer to that as the low day. Not a terribly sophisticated name, But then subsequently, the trader might look for a closing price above the highest point of that low day. So looking at recent examples, here we had a retracement down to our price floor. We have this red candle that was the lowest day as prices were selling off. And so the trader might look at the high point, and I might need to zoom in on this one so you can see it a little bit more detail. Let's zoom in on just these last maybe 4 months. So here's this pullback. There's the candle that stuck its tail down the furthest. So we look at the highest point of that low day. And then when prices close above that, for some traders, they may interpret that to be a resumption of bullishness in the short term, signaling that maybe prices are going to rise from here. So there is our bounce entry, sometimes abbreviated to the acronym CAHOLD, close above the high of the low day. Now we see another example here. Price got pretty high off of that trend line, fell back down to what may be a support. So here's our lowest day as we touch that support. And again, the trader might be looking at the highest point of that low day and looking for a close above the high of that low day. And that looks like that may have happened on this candle day. So it might be as we're closing above the low day's high. Now look at where we are right now on Amazon. We pulled back down to that trend line, possibly a rising price floor. Here's our low day, that red candle day from 2 days ago, would have been last Thursday. We reached down to a low. If we look at the high of that, trading's not done. We still have an hour and a half of trading today, but it looks like we're in good position for a potential close above the high of that low day. So we have a possible entry. Now, for some traders, that's adequate. But I wanted to show how, for some other traders, they may want to see just a little bit more technical evidence for confirmation of this bullish signal. And so for this, we're going to be recruiting what to some is going to be a familiar indicator. It's the moving average convergent divergent histogram, which is a bit of a mouthful, more commonly referred to it as the MACD. Let's add that to our chart. I'm going to pop up here the little flask icon. That's our edit studies icon. Let's type in MACD, and we're going to choose MACD histogram. Add that to my chart. Let's click apply and click OK. As I do that, bear with me for just a moment. I want to do one thing off here to my side screen just to kick things up. There we are. Okay, had to reinitiate my chat, but we just loaded up our MACD. I want to talk about this momentum oscillator that's sometimes used, yes, by covered call traders in their effort to time the purchase of the stock, but also to time the sale of the call option. Now, with that sort of intriguing and tantalizing statement, I'm going to hit the pause button on the presentation here for just a second because I see that there's been a survey that's been added to the chat window for those that are here in the live stream. We always like your feedback. Let me just tell you a couple of things about that survey. Please, if you would, click on that survey link right now. It'll bring the survey up, and you can just park it and fill it out when we're done with the webcast, and you can give me some honest feedback. But the first thing you should know about the survey is it's really short. 2 multiple choice questions, a comments box, and a suggestion box. But I also want you to know that if you take the time to fill out that survey, I'll take the time to read it, just like Evo was talking about how Scott was commenting about surveys. We do read those surveys. It definitely helps. Never wasted effort. All right. So thank you for doing that. But back to the presentation. Looking at the MACD histogram now, I want to give a quick introduction to how this might typically be interpreted. There are a number of different ways that this momentum oscillator might be interpreted. But one way is, for some traders, they just see this as a tug of war. It's representing that tug of war between buyers and sellers. Sometimes the sellers gain significant control, interpreted sometimes as momentum, as selling momentum. Other times the buyers get the upper hand, and we might see buying momentum. But in this tug of war, the trader might be looking for extremes. So when we see a deep dip on this MACD histogram, this is commonly interpreted to be the sellers are firmly in control of the short-term momentum of price. This is selling momentum is the interpretation when we see these long bright red candle sticking down below the histogram 0 line. Now, if we shift from bright red to dark red, I call that a red shift. That may represent that the sellers, they still have the upper hand, but the grip is slipping. We might be seeing a shift of the momentum from sellers to buyers. And so if we get that red shift, that little event, let's draw a little oval around that. If you see this bright red to dark red, that may be a confirmation to some that price is set to go higher. The buyers are retaining control. Maybe they've dug their heels into the dirt a little bit better, giving a harder yank on the rope. None of that adds up to a guarantee that price is going to go up. But in this case, it looks like it is in early days. So there's a combination of a few factors here for the timing of the stock entry. Number one, looking for a price floor. Number two, looking for short-term confirmation in price activity, meaning a white candle rising above a recent red low. And then finally, the confirmation on a MACD oscillator being a red shift from bright red to dark red, signaling that potential shift in momentum. So all of that, if we were just, if we're a stock buyer and that does call the lows, awesome. Price goes up, the share owners are happy. But the point of this discussion is income. So what might be the timing of that event? So here's my question to you. Looking at things traditionally, when we sell a call, is that a bullish or a bearish action to take? What do you think? Stock ownership, bullish. Selling a call against a stock position is actually technically a bearish trade to take. And so that might inform us for what the trader might be looking for on the chart behavior. It's going to be pretty much the opposite of what we just learned for timing of the stock. Timing the stock, we're looking to optimize the bullishness of the chart. Timing the selling of the covered call position, typically a trader is looking to optimize the sort of bearish signals on the chart. Now, that's kind of counterintuitive because we are shareholders, and yes, net, a covered call, because of the ownership of the stock, is overall a bullish trade. Okay, yeah, Mark says selling a call on its own is bearish, but if you're buying the stock as well, ... says Mark, and he's exactly right. Yep. But obviously, as shareholders, we would just prefer shares to just do this, right? Just go up and up and up and up. Never stop. Just keep going up. Is that realistic? Nope. So if what the trader possibly already sees as inevitable starts to occur, if the stock stops going up and starts going down, there are a few things that they might do with that information. If they really think the stock is going down, maybe they just sell it. If they don't want to sell it, maybe that's the time for income. All right. But in any case, what might the trader be looking for as a signal that the stock is about to go through a bit of a pullback? Well, maybe instead of being down at a price floor, maybe we're closer to being up at a price ceiling. So for example, there appears to be a pretty good price ceiling around that 235 level recently. Doesn't mean that the stock can't go above that, but maybe it hesitates if we get back up into that range again. What might we look for on a candlestick basis? Well, instead of looking for getting down to support and then seeing a white candle taking us up off that support, maybe up at resistance, seeing a red candle taking us down from that resistance. And finally, what might the trader be looking for as confirmation from their MACD? Well, instead of a deep plunge into bright red, shifting to dark red, it might be a high rise into bright green, shifting to dark green, much like what we saw. This one isn't terribly high, but here we got above the 0 line on a momentum oscillator, meaning basically that tug of war is in balance. The momentum moved firmly to the buyers, and then their grip started to slip right here. And you can see right there, we're shifting, red candle, shift in momentum. At that point, again, maybe the trader just sells their shares, or if they don't want to sell their shares, maybe they turn to an income strategy. That might be selling the call. So here's what we might do today. I could just buy the stock, and then we could meet again next week and see if things have reversed yet. if we've gotten up to that resistance, if we're starting to see red candles going the opposite direction, if we're starting to see our oscillator, if it's gone to green, maybe it's shifting to dark green. Or a second approach is to just sell the covered call even while the stock is down at support, but still using the information of the resistance up here, that price ceiling. Here's what I'm going to be doing for today's example trade. It'd be nice, and we could do this. I'm not going to do it. We could just wait for the bearish signal, or a trader who wants to get in and sell. Maybe they just sell up there at that resistance, anticipating that even if price does rise, it's likely to turn and start coming back at that 235 level in this example. So as we do that, I'm going to go place the trade. Let's go to the trade tab. I'm going to stick with that October 17th expiration. So we're going to be looking to buy some shares. Looks like maybe in the neighborhood of 221.5. We'll see what those shares fill for. But at the same time, I'm going to sell a call up at that resistance level. I might need more strikes here visible to me so I can see what that call. Am I going to be able to get much of a credit up there? What was that? Maybe I looked at 235. I don't need that many. I was thinking 265. 235. I don't even need that many strikes. 235 call looks like it's trading between 157 and 159. Maybe we can get a $1.58, something like that for that premium. But let's purchase some shares. Now, at this point, the trader would want to look at the price per share. How much can they afford to purchase? I'm just going to do 100 shares as our example today. But I'm going to right-click at that strike and put in a buy order for covered stock. That's Thinkorswim's name for covered call. Same thing. So we're going to buy, let's just do one contract, selling one contract, buying 100 shares at that 235 strike. The net between paying 221 and change for the stock minus maybe $1.50 for the option, it's going to be around $220. Let's say that we're willing to spend a little bit more just to try to increase our likelihood of a fill here. I'm going to click confirm and send, and I want to get this order filled, but I want to go back to a little pros and cons discussion of the timing of what we just did. Okay, so let's buy this 17th of October stock, buying 100 shares of stock, selling the 235 call, trying to get that for a net of $219.95. If we do, about $22,000 tied up in this trade. If we get called out, that'd be $1,505 of reward potential, and there is a commission of 65 cents to be paid here. So let's send this order off, see if we can get that filled. What's it looking like on our working orders on the monitor tab? So, look at that. We're right there. $219.95 is what we're offering to pay. $219.97.98. It's starting to run on us. What's probably happening is the price is probably strengthening. So it's getting more expensive. We might not get filled here. Let me do this. Let me cancel and replace this order. I'm going to nudge this up. Let's say we're willing to pay $220. We're chasing it a little bit. This is reality. I mean, it's fake trade, but this can definitely happen in reality. Let's click confirm and send, replacing that original trade, just bumping up the amount that we're willing to spend. So yeah, the maximum loss just went up a little bit. Still a commission to be paid here. See if we can get that filled. All right, that's a little more likely. There it is. But that trade, here we are. So we're in 100 shares of Amazon, sold the one call, and you're probably saying, Cameron, you just told me to wait for all of these factors to sell that call, and then we didn't do it. We didn't wait. Why would a trader choose to get in when we're down at support and it looks like the stock is going up instead of waiting for hopefully price to rise up to that resistance? There are pros and cons to that. Buying the stock right now and selling the call gets us into that trade. Also, we just sold a call that is way out of the money. Stock's at 221. We sold up here at 235. This stock has quite a bit of wiggle room before it even gets up to that resistance. Now, we have all that cushion built in, but what does that do to the premium that's collected? So there's a pro here. There's a lot of wiggle room to the upside for our shares. The con there, the trade-off is the premium is smaller. We got about a buck. What did we probably got? $1.58, $1.60, something like that for the call. We go check. Look at our filled orders. Yeah, we got $1.58. Okay. Now, if a trader waited, let's say we just bought the shares, and let's say the stock does rise up to 235, and then we look to sell a call, there's potential pro for doing that. Number one is the premium is very likely to be much stronger because the price would be much closer to that strike at that time. And when strikes are closer to the current price, they typically are larger. Well, that's great. Maybe a higher income potential. What's the trade-off? Well, we'd also be up there closer to where we're running the risk of assignment. Now, there's not as much upside wiggle room on the stock. So there are pros and cons. I debated just buying the stock and then waiting to see if we got up to resistance and then entering the call to sort of hammer home the timing element of the technique that we learned using resistance, red candle, and a green shift on our momentum oscillator. But I think that left open the opportunity for a discussion of, well, what are the pros and the cons of not waiting for that event? So we did it anyway. All right. But guys, we've accomplished what I set out to do today. Now, what we need to continue talking about is the management of these sorts of positions. And so each week we come back and we talk about existing positions. And when we choose to exit one, we talk about the logic of why we're choosing to exit it. So I hope that you'll join me in future webcasts, but that's going to do it for today. This is what we do on our Mondays. We talk about trading covered calls. I have other webcasts in between now and then. You're certainly invited to join me in my other webcasts. Ben, thanks for helping out there in chats, guys. I'm going to let you go enjoy the rest of our webcasts for the day, but I also want to give you some reminders regarding the resources that are available to you from Schwab Education so you know how to take advantage of the full range of educational offerings. Number one is outside of these live streams, best place to watch these videos is to check out the playlist. So do yourselves a favor. If you haven't subscribed to our channel yet, do that right now. The channel on YouTube is called Trader Talks Schwab Coaching Webcast. You can subscribe down in the lower right-hand corner. Just click on the subscribe button, or you can go down below the live stream, click subscribe there. Doesn't cost you anything to do that. It only takes a second to subscribe, but our channel is where we house our playlists of previous webcasts. We can find those right here. So for example, if you wanted to see my discussion from last week where we sold a short put, you can click on playlists. We can scroll down. This webcast series is kind of toward the bottom. So if you move on down toward the bottom, there it is, second column, trading covered calls and short puts. You can click on view full playlist. And there was our discussion. Options for cautious traders, selling puts for income in slower market months. That was a good topic for last week. Another thing that I would strongly suggest is that if you have an account on X, follow your favorite presenters there on X. It's the best place to connect with us in between these live streams. So you can find Ben on X at Ben Watson CS. You can find me there at Cameron May CS. And if you reply to one of my posts, I try to reply right back to you. I already see some of you. You know who you are that I've been having conversations with right here on X. Like, for example, I just posted yesterday, beautiful drive I went on. Some of you have already commented, and other times I'll post about the markets. You comment, I reply back. Great opportunity for connection in between the live streams when the camera's off. Also, this is my quick final reminder, time to fill out that survey. Your comments are always valued. Click that survey link, a couple of multiple choice questions, a comments box and a suggestion box. If you leave a survey feedback, I will definitely read it. All right. Thank you, everybody, for clicking on that like button. I can see over 100 people watching, and about half of you have already clicked the thumbs up, 47 likes already. That's very much appreciated. Thanks for doing that, because that's like a pat on the back for your presenter, but it also gives a boost to my video in the YouTube algorithm. helps more people find these sorts of discussions, like how to use charts for the timing of covered call entries, buying the stock, selling the call. All right. Yeah, Janelle, I know you gave it a valiant effort there, Janelle. Answered one of my questions. How did I do in making up some fake candlestick names? Yeah, that's what those were. Here's what Janelle's referring to. I said, what in the world is this candlestick pattern? 3 of these 4 I just made up. One of those is actually a valid candlestick title and carries implications for technical traders. Anyway, for those that use candlesticks. All right, everybody, but time for me to let you go. Go enjoy the rest of the day. I will see you in a future webcast. I'll also look for on X. Ben, thanks for helping out in chats. Everybody have a great day. Until the next time I see you, I want to wish you the very best of luck. Happy trading. Bye-bye.